Former Federal Reserve Chairman Alan Greenspan made plenty of news in 2008 when he admitted that the Fed's failure to anticipate the risks and consequences of scrutinizing and selling mortgages, which eventually led to the global financial crisis, was due to poor forecasting. But chief financial officers of companies seldom have the luxury of going wrong in financial forecasts. What with words like growth estimate, EPS guidance, and folio projections becoming a commonplace in financial reporting. Every quarter, the CFOs need to roll out these numbers to investors, lenders, and other stakeholders, and then come back the next quarter to justify the differences, if any. And all this goes much beyond a traditional function in finance.
It occupies a fair amount of our mind share in the finance team. This is because we act as an intermediary or a glue between all the different departments of the company, be it sales or operations or other support services. So we act as a wire media. We act as a sounding board, saying that do these projections sound right? Are they aspirational or are they actually lowballing those sales? So to act as a mediator, it is a very important role. We are also closely involved in preparations of the budgets, forecasts of the company, as well as interaction between various stakeholders like the shareholders of the company in our business to give them a heads up on how much capital we are going to require, and that has a close bearing on what kind of projections, sales projections that come through the door.
Even as financial forecasting becomes an increasingly challenging thing to do, CFOs admit it is not something they can ignore.
Forecasts are very critical to running a business because we need to really be very sure about resource allocation. So there are a whole host of support activities that go in supporting a level of sales. So if, for example, business development teams are tell you that this is X amount of sales that are going to come in quarter on quarter, then you need all your, in our industry, for example, how many operation staff, how many support staff that you would have to be able to service that level of business. So if there's a large mismatch between what actually comes in through the door and what is it that you're anticipating, that could result in a very unfavorable level of expenses that we have ramped up.
Profile of a CFO today consists mainly of making financial projections as well as making sure that we achieve the financial projections, primarily because there are a lot more persons involved in analyzing the progress of the company, and has changed considerably as compared to the last few years. Primarily because the exposure of the enterprises has increased multifold as growth has become a very important objective in every organization. And this leads to spanning out to various stakeholders, just not investors alone, probably investors, financial institutions, sometimes vendors, sometimes prospective human intellectual capital, and this makes it very important for the company to give guidance to various people on the growth path of the company.
According to a 2008 survey on CFO.com, 39% of CFOs polled on a spot survey on the website said they could reliably forecast revenues for just as far as the next one quarter. Only 11% said they could forecast reliably for the next 3 quarters or more, while 19% said they were sure of forecasting reliably for 2 quarters. 15% said they could forecast for less than 2 weeks, while 16% said they were still in the dark.
Mostly projections, at least external to the company, have been on an annual basis. Earlier there used to be pressures on quarter on quarter, but plenty of stakeholders have begun to realize that projections on a quarter-on-quarter basis may not be all that relevant as long as, the comparison is basically more on tracking the actuals to see whether they are meeting the requirements of an annual forecast. So the quarter-on-quarter forecast has not been so very important of late. It's more a 2-year or a 3-year outlook that is more important for making financial projections.
The recent credit crisis and the downturn in world economies may offer a useful lesson. Forecasting can't just be about number crunching. As Indian companies become more aligned to global trades, the challenge is clearly to be able to make forecasts while taking into account not just local factors but global ones as well.
We have a lot of dependency on regulations. For example, there was cap charges that came about, which we had to refile all our products. So that had a big bearing on what our projections might be, because we were to some extent charting into the unknown with the new set of products on how it is going to be received, what is competition doing. Also the recent SEBI IRDA dispute that we have seen. So how is that going to, what kind of a bearing that would have on the future of this industry? So there's this entire regulatory aspect that our industry faces time and again. Then there's also the seasonality. So given that typically we have seen 35 to 40% of our business done in the last quarter of the year, so we really don't know until towards the end of the year how the year is going to pan out. So we are working very hard 3 quarters of the year, and then if sales don't come in the last quarter for whatever reason, sometimes it's macroeconomic reasons like we saw a year ago, then again you're left in a difficult situation. So seasonality does bear. There's also the tax reason. It's fortunately reducing now, but in a few years ago, tax was a major driver of buying insurance products. So, and that happened typically in the month of March. So there are several aspects to this.
There are a lot of micro challenges, macro challenges, especially when we look at markets which extend to the entire globe, and reading economies of various countries which make a significant shift in fundamental factors like demand and supply can affect the financial projections considerably on a macro level. At a micro level, of course, industry sector changes can make certain issues very complicated. And there are so many of these unknown factors which keep coming up on account of certain large corporations not faring well, which could have an impact on the financial markets itself, and therefore can affect the market cap and things like that of the organization.
Business leaders also look up to the government to set stable legislatures so that there is more flexibility at the planning stages.
More transparency, especially from the regulatory bodies like governments, and possibly more transparency from large corporations, which can have an effect on the economy. Like today, if we were to find that a large company like a Reliance has either an adverse impact or a positive impact on the stock markets or the economy of the country, there is more transparency from such large corporations as well as the government in terms of whatever legislations they are projection. These two things can make a big difference to making financial projections.
Whether companies think long or short term, the ability to react quickly to events is really all that CFOs can ask for forecasting.